And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Hi, I'm Lance Roberts, and welcome to The Real Investment Show. Today is one of our ongoing continuing interview series, and today our special guest is Peter Atwater. He's the adjunct professor of economics at College of William and Mary, president of Financial Insights, author of the book, The Confidence Map, Charting a Path from Chaos to Clarity, a longtime observer of the markets, and really the person that coined the term, the K-shaped economy. So we're going to be talking about a lot of stuff today, really kind of getting into his book, talk about the K-shaped economy, and kind of just other stuff wherever this conversation goes. Peter, welcome to the show today. How are you?
I'm doing great. Thanks so much.
It's great. You know, I'm a big fan of your work. I've been following your work for a long time. I retweet you a lot on Twitter, X, whatever they call it these days. So, you know, I really enjoy the stuff that you write about. So let's talk just real quick. You know, touch on your book here a bit. You know, you came to economics and behavioral decision making, you know, after a long career in finance and securitization. You know, so, you know, how did that kind of background lead you to this understanding of confidence and the way it relates to kind of everything in terms of the financial markets?
When I left the industry, it was right before the financial crisis. And I was writing a lot about what I could see coming because, you know, with a background in banking and securitization, kind of knew where things were headed. But watching investor behavior, I became really interested in why people were making the decisions that they were. And so my initial focus was to try to better understand the behavior of the herd, as it were. Mm-hmm. And the more I looked at that, the more I realized that the concepts that I was talking about applied more broadly to all of us, whether in our jobs, in our lives, in what we eat, what we do. So I really became much more sort of horizontally focused on decision-making broadly and its connection to how we feel.
And so that was kind of the aha moment. You know, when we talk about confidence, you know, that's kind of certainty and control. And then that's kind of that missing ingredient that, again, and this is why the Fed focuses on it, right? You know, the Fed does QE to boost consumer confidence through higher asset prices, right? So it's that kind of certainty and control that, you know, leads people to kind of this consumer behavior and the broader society, right?
Yeah, it all comes down to those two things. And we need both of them to feel confident. You know, one without the other isn't enough. We somehow feel vulnerable if we don't have them both.
I think we would all like more certainty and control. That certainly seems to be the case. Well, so in your book, The Confidence Map, which, by the way, if you haven't read his book yet, it's a fantastic read. You can get it through all your favorite, you know, book retailers, Amazon, Barnes & Noble, etc. But it's an excellent read. But it really lays out quadrants, kind of a quadrant framework of confidence. And, you know, kind of for the audience, can you kind of explain how sophisticated investors are used to talking about flows and valuations and fundamentals? And how would you explain that basic idea?
Yeah, so when I realized that it required feelings of certainty and control, I created a 2x2 box chart with certainty on the x-axis, control on the y-axis. And I looked at them independently. When we have both of them, I call that the comfort zone because we feel great, things are relaxed, it flows. When athletes talk about that flow state, it's because they feel certainty and control of what they're doing. And that's the upper right-hand box. Mm-hmm. At the other extreme, the lower left-hand box is what I call the stress center. Because when we don't have certainty and control in our lives, we feel naturally anxious. And we're not our best selves. We're impatient. We're not kind to other people, not necessarily nice to ourselves. And when people think about confidence, those are the two boxes they think about. You either have it, in which case you're in the comfort zone, or you don't, you're in the stress center. What I then looked at were these hybrid boxes, The lower right-hand box, where we have certainty but no control, I call the passenger seat. Because if you're on an airplane, you hope you have certainty, but you have absolutely no control.
Right.
And what's interesting about that box is it can go from feeling very comfortable one moment to feeling almost like a prison the next. And you can see that firsthand when there's turbulence on an airplane or when you're in line for a roller coaster.
Right.
The upper left-hand box I call the launch pad, and that's where we have control but no certainty. And one of the things that investors don't appreciate is that that's where all of our financial transactions in life happen. Whether we're borrowing, lending, investing, saving, they're there. And that's what makes finance so unusual, is that the outcome isn't known. And so when we're making decisions, particularly investment decisions, we have to imagine the future. And it's that imagination of the future that drives what we do. Mm-hmm. Ironically, what we don't appreciate is that our imagination of the future is entirely dependent on how we feel. It's the best mirror I know of how an individual feels in terms of confidence. Just tell me how you picture the future, and I will tell you exactly where you are on this map.
It's very interesting too, because, if you kind of look at kind of the markets in general, you see that a lot. People are very confident of, the markets right now. Markets are going up. Doesn't really seem like anything can go wrong. I would presume if you put investors on your quadrant, they're probably in the upper right-hand quadrant right now because of the amount of risk taking we see in terms of leverage and speculation, those type of things. But that also leads them, to your point, they're very optimistic. We look at consumer confidence measures as a function of people. What do you think about, market prices a year from now? Oh, they're definitely going to be higher, right? It's just there's total future confidence because everything's going so well right now. But that also there inherently lies the risk, right?
Yeah, because when we say we're confident, what we're really saying is, I will be confident, that it's entirely forward-looking. And when I look at the AI space and I look at the measures of sentiment that you talk about, they're telling me people are somewhere in that upper right-hand corner. Mm. And they think that that can just go on forever. And that's one of the things that I always see, is that there's a sense of power to the momentum that's pushing us towards greater and greater opportunity. And that's something investors need to be really careful about, because that's often misleading us in terms of the decisions that we should make.
So, and so this is kind of interesting too, because, when we talk about the markets, right? So again, we were just talking about the markets. We say, look, you take a look at what's going on in the markets, upper right-hand quadrant, everybody's super optimistic. Everybody's making money hand over fist right now. You just kind of throw money at the markets, you make money, everybody's good. This kind of really feeds into your, kind of your point that the term that you coined, this K-shaped economy, because what we're talking about is a very small fraction of the economy that's actually participating. 10% of, the top 10% of income earners own roughly about 87% of the stock market. The bottom 50% really not participating much. And that's really creating this bifurcation in the market and the economy, where there's parts of the economy doing very well, at least on the surface, and then other parts of the economy they're doing just terrible. And we actually even see this in the markets itself. You see 10 stocks that are doing fantastic, the other bottom 493 stocks, not really doing all that well. We see it in market breadth, we see it in a lot of different areas, which is a reflection of economic activity and really kind of goes to the heart of your point about the K-shaped economy. Could you talk a little bit about what led you to this idea of the K-shaped economy and what you're seeing now?
Yeah, so back in March of 2020, so right after COVID hit, I saw something dramatic in terms of confidence. When white-collar workers could pivot to work from home, their confidence spiked because they suddenly felt like they had certainty and control in their lives. They were going to continue to get paychecks. They saw the benefits of monetary and fiscal policymakers. So things quickly turned up for those that worked from home. blue collar workers, nurses, you know, supermarket clerks, folks that worked in the real world, their life just got harder and harder during COVID.
Right.
And when there was this land grab for letters, some economists saying, I want V, I've got L, I got U. I latched on to K because it was like, look, this is the reality. It's getting better for a handful and it's getting worse for a lot. And more time has passed, and that divide has just gotten greater and greater and greater, to the point where you can use that term, the K-shaped economy, and people nod in agreement that, yeah, got it. I know exactly what you mean. The wealthy are doing extremely well. Those at the bottom are in despair. And that, to me, from an economic perspective, is really precarious. I think of our economy today as a top-heavy Jenga tower, because at the bottom, the blocks are being pulled away. Meanwhile, those at the top are in this circular swirl of AI, rising markets, consumer spending. They're living like there's no tomorrow, while those at the bottom aren't sure how they're going to make it through today.
Yeah, I coined the term F-shaped economy, but it never really caught on. So just, but the issue though is, and this goes a lot deeper, and we've had a change in administrations, right? We went from the Biden administration to the Trump administration. We've seen a lot of policy changes. We've seen, the onset of tariffs, the debate over tariffs, the potential now, depending on what the Supreme Court decides, the potential repeal of tariffs. But none of this really seems to be filtering down into the latter, that kind of that bottom tier of the economy, really in that kind of that 60, 70% of the economy that's just struggling to make ends meet, trying to get by, trying to figure out how to pay bills, raise their families. Again, to your point, they're just trying to figure out how to get to tomorrow, not thinking really about taking advantage of tomorrow. What changes that? I mean, how do we get back to a non-bifurcated economy, in your opinion?
So it's going to take sacrifice on the part of those who are most able to influence. So those at the bottom are looking for things that are more affordable. So we know that it's the cumulative effect of inflation that's really biting those at the bottom. Economists spend a lot of time caring about the annual changes. That's the wrong way to look at inflation at the bottom. It's the cumulative impact. And it's not just in what they eat, it's the cost of cars, it's the cost of housing, childcare. They feel vulnerable in multiple dimensions at once. And if I'm advising policymakers, I think that if we're going to help put a floor on the despair of those at the bottom, we need to start at the bottom of Maslow's hierarchy of need. So until basic needs are satisfied, we can't focus on, how do I get a better job? How do I educate myself to build skills that I don't have? Because I'm preoccupied with, will I have enough money to make it through the month? So we need to think about, how do we help buttress those at the bottom, particularly who have been disenfranchised because of changes in technology, in outsourcing. At the same time, we need to make those at the top much more aware of what's really happening around them. One of the most disheartening things, Brent, to me about COVID is it created an ability for those at the top to be blind to what's happening around them. When COVID hit and people could live and work from home, they no longer had to interact with those at the other end of the economic spectrum. And I think it's only gotten worse. I mean, there was a whole article in the Wall Street Journal recently on how the ultra rich are doing all they can to avoid interacting with the bottom. And I think that's a mistake.
But this is the problem with potential solutions, right? During the Biden administration and going into the Trump administration, we sent checks to households, right? Well, we need to help people because we've shut down the economy. Let's send checks to households. And that led to very bad consequences due to inflation. because you increase demand, and at the same time you had no supply. So or if you increase child tax credits, right? We want to make sure people have more child care, so they can go out and spend less money. They've got their child care taken care of, but now they can go out and do other things to create income to pay for the other stuff. Well, the problem is you increase the child care tax credit, or you give them child care credits, and the child care providers raise their prices. And so, they may get relief for 6 months, a year, but then eventually that's all priced out, by the markets because of inflation, to your point. So what are the, again, I understand what your kind of your thoughts are, and I certainly agree with them. I'm just not sure how you get there, through monetary or fiscal policy to try to support these things, because the negative consequences, look, part of the problem we have today is we held interest rates at zero for way too long. Trillions of dollars of QE inflected into the system, lifted asset prices for the top 10% of income earners, didn't help anybody else. So all these policies we've tried haven't worked. So, the only solution, for instance, let's take housing as an example, right? Housing unaffordability. It's a big problem. But we keep doing things that keep houses unaffordable. 3% down payments for mortgages, split mortgages, adjustable rate mortgages, all these type of things that keep allowing more and more people to buy homes that, whether they can or cannot afford them, it keeps the price elevated because you're keeping demand within the system and supply isn't getting built. So, if you go back to a 20% down payment, high credit score, you'll reduce demand, you'll bring home prices down, and you'll bring affordability back, but you're going to impact the entire economy in the process of doing that. So is there any feasible solutions to fix the problems that you're talking about?
Your points are exactly right. And so for policymakers, the choice then is, how do I create, income caps on the provider side? So to your point, so much of this is a conduit from the poor to the rich.
Right.
To the, and so in this process, policymakers are going to have to be clear that their intent and their management of this is to provide those at the bottom more stable footing. And as you can appreciate, that the problem with a K-shaped economy is it creates a slave of two masters situation for policymakers, because they end up looking like Robin Hood in some way. And we know that our two established parties are heavily dependent on those at the top from a financial perspective. And so they are loath to get involved in that. And one of the things I've said to policymakers on both sides is they need to be cognizant of the fact that ultimately voters will take matters into their own hands. I look at the election of Mr. Mandani in New York. New Yorkers didn't move to the left, they moved down. And so those on the left and right, in terms of the establishment, need to realize that voters will find alternatives that are more socialist, more progressive than exist today. And I'm not suggesting that that's the right outcome, but I think that's the outcome that evolves if we're not mindful of the plight of those at the bottom.
No, and look, and what you saw happen in New York is not surprising. Again, to your point, when things get to a point where it doesn't matter what I do, I feel like I can't get ahead. And here's a guy promising me free stuff, right? I'm gonna have government grocery stores. We're gonna price cap rents. We're gonna do this type of thing. It doesn't, regardless of the aspect that he probably can't achieve a lot of those things because of New York policy. But it sounds good. It's fine. Give me that because the other system isn't working for me, even though we know, historically speaking, socialistic, communistic policies don't create economic prosperity. Capitalism has done a great job of that. But again, when you push enough people into a box, they'll vote for that because the other side isn't working. They'll vote for something different simply because.
They will always choose better, not best.
Right.
For them. And it's truly for them at an individual level. And I think the risk to both of our parties today isn't someone like Mr. Mamdani, but an individual named, Bob or Jim or Paul or Mary from Kentucky who has the ability to unify both sides at the bottom. I think we forget that the bottom is really purple, that it's not red or blue. You go across the country and you can see these populations across the political spectrum.
No, I absolutely agree. I've said this so many times, is that if you talk to the average person, they are generally slightly left or slightly right of center. They're not, and what we've done with politics over the last really 8-10 years is we've created this idea that there's these two radically different positions of policy in America. You've got the red, the Republicans on one side, the uber conservatives on the other side are these kind of very democratic liberal extremes. But that's not the majority of people. The majority of people may have views on both sides. I may be pro-choice, but fiscally conservative, or vice versa. And and I think to your point exactly, if a leader comes to the fore that says, "Hey, I can cater to both these sides, and I can provide better outcomes," I think you could see, potentially, and I've said this for a while, is that we now have the best opportunity for the rise of an independent party that we've ever had in the last 150 years.
Yeah, and anti-capitalism could be a very compelling, unifying message that those at the top really underestimate today.
I agree.
Because the benefits have flowed to so few.
I agree. And it's a terrible thing, by the way, to this idea of moving towards socialism, communism. The outcomes do not get better. You do not get better economic prosperity across the masses. You still get the uber rich and everybody else just gets poorer. But, again, you got to be, as is always the case, you have to be careful what you vote for, and understanding these policies. And that's where, this is, my problem that I have. And we're about to move and talk a little bit about the current market and macro environment. But this is the problem I had with the Federal Reserve. The Federal Reserve, back when I was growing up and I started in the business back in the 80s, you walk down the street and ask people, who's the Fed Reserve chairman? Nobody had an idea. I mean, these guys were in the background. They were in a closet somewhere. You certainly didn't know who all the Fed members were by name. And today you ask just about anybody, it's like, who's the chairman of the Federal Reserve? Oh, it's Jerome Powell. Which Fed speaker's talking today? Oh, it's Waller. It's whoever. The Fed has become so front and center to the financial markets, and they're in a place that they should have been to begin with, and they've provided so much influence over, and again, I've talked about this before, and I think this goes to your point, Peter, is that it's been Robin Hood, to your point, in reverse, except we stole from the poor and gave to the rich, because all of these policies, zero interest rates, quantitative easing, monetary accommodation in various forms, has acted more as a wealth transfer system from the poor to the rich than just anything else. And you can see this in the flow of monetary velocity, which is that whole transmission system has been broken now for the last 15 years, ever since we started this stuff, post-financial crisis. So, I'm not sure how to fix that, other than you've got to get policymakers out of the business of supporting markets and allow the markets to start functioning for themselves. Winners are winners, losers are losers. And if a bank goes bankrupt because of bad choices, that's on them.
Preaching to the choir.
Well, this has been my beef for a long time. We should have never bailed out JP Morgan, Goldman Sachs. We should have, a much broader range of banks than we do today.
Well, and I think we need to rethink all of this top-down, trickle-down economics, because what we've seen is, particularly post-COVID, is that there was no trickle down. Right.
Sorry for my rant there for a second, but this is very near and dear to my heart, the stuff we're talking about. So in your recent, you were recently on a podcast. You talked about what happens when social trust collapses, and you really explored this idea of social trust, confidence, powerlessness that intersects in the economy. So kind of from that vantage point, is the market right now dominated? Or let me rephrase that. How do you view the markets currently in the current macro environment, and what are your concerns?
So my concern with the markets really centers around AI. We love abstract things when confidence is rising, and I can't think of something that is more abstract, not just in its design, but in terms of who's using it, what it does, who's leading the charge. AI is about the furthest thing away from Main Street that I can think of. And so I think that investors have embraced AI because they see nothing but possibility. The danger that I see with AI is that when confidence turns, and I see indicators that this process has begun, what once looked like possibility begins to look like threat and a reason for people to be worried about it. And none more so than those on Main Street, who now view it as a reason they may lose their jobs. It's a reason to be angry at those at the top. And when I look at our economy today, it feels like a really top-heavy Jenga tower. That at the top, we have this swirl of liquidity because we've got record markets, we have enormous spending in AI, and we have this upper end experience economy where those who have resources are spending it like there's no tomorrow. And I think we forget that those aren't individual pillars. That's a circle of flows. And I worry about when does one of these conveyor belts stop moving? Mm-hmm. Because when that happens, they're all likely to stop at once.
Yeah, no, it's a big concern. Again, there's lots of conversations about how the current AI situation reminds whoever it is saying it of 1999. And, I was in the middle of that in 1999, the dot-com boom and bust. And there's certainly a lot of similarities. We're seeing some of the same activities, some of the same speculation. There's a lot of differences, though. Companies today have, billions of dollars worth of revenue versus a lot of companies in the 90s that didn't. But, for investors who are, accustomed to using things, and again, I'm old school, so I still use things like fundamentals and valuations, those type of things. How should an individual think about incorporating confidence into that kind of, analysis for markets and investing? How does that fit in?
Yeah, so I recommend that investors reconsider their multicolored pie charts and to look at them as being individual measures of mood. And I encourage investors to think about how hot are these different slices of your pie. Mm-hmm. Because if you have AI and a portfolio of AI stocks, gambling stocks, some Bitcoin, you have a pie that is all the same temperature. You may think you're diversified, but the moods are, everybody involved in those are tightly correlated. And so I think investors need to be thinking about, what should I own today that is ice cold, that nobody wants? What are things that are lukewarm because ultimately what creates adequate diversification is a variety of moods in your portfolio, not just assets.
No,
one of the points I make to investors a lot is plan for what you can imagine, but you need to be prepared for what you can't. And so spend some time thinking about where are your blind spots and how would you protect yourself if these unforeseen events, or what I think of as unimaginable events, took place, because you're going to want something to protect you.
Sure. And I was talking about this a few months ago. Gold was going up, gangbusters every day. And there was all these articles out. Oh, nobody wants the dollar anymore, and gold's going to go to 10,000, whatever the number was. Same time, Bitcoin's running higher, stocks are doing well. And I was warning back then. I was like, this is fine, but whatever your narrative is, just understand that you now have a correlation between all these asset classes that's now gone to one. So when they correct, they're all going to correct together, which is what we're seeing going on right now. Bitcoin's had a big drop over the last couple of weeks. Gold's down, stocks are down, et cetera. And to your point, this is really hard for investors to get their head around because, I get calls from our clients and it's like, I don't understand why we own Berkshire Hathaway. That stock hasn't done anything this year. why don't we own more of, Meta, Google, whatever, because those are going up. And I always try to reiterate this, and it's like, look, it's not about the fact that this isn't doing well. Staples haven't done well this year at all. You take a look at the ratio between the S&P 500 and Staples, it looks terrible. But that's where money's going to go when you get this risk-off rotation in the markets. Whatever happens, money doesn't leave the market. It goes somewhere. And so the trick for an investor is to understand that some of these cold spots, to your point, is where money's going to gravitate to, because those are undervalued. They have value, they have growth, whatever it is. Money's going to seek those opportunities out, and that helps balance your portfolio, reduce your risk. It helps you weather these downturns in the markets. The problem I see with investors is they get so confident, to your point, their confidence gets so high. They're so far up in that upper right-hand corner that they're only invested in everything that's going up, and they're not paying attention to what happens when that potentially reverses.
Yeah, and your point about they're not paying attention is so important, because scrutiny and confidence are inversely related. And the more confident we are, the more risk we take, and the less attention we pay to the risk that we are taking.
Exactly. So let's just, kind of spin this around. So, if you're advising a sophisticated investor today, caveat obviously that you can't make recommendations, and nobody's saying these are recommendations. We're just talking about concepts here. What one behavioral question would you pose to them to test whether their portfolio is over-levered on confidence?
What do you own that's tangible? What I know is that when confidence is really low, you think about stuffing money in our mattress. That is the ultimate measure of tangibility. I can physically hold it in my hand and it's in my house. And so I'd like to ask investors, what is tangible in your portfolio in terms of what's useful, what's real, what has immediate value in a crisis? And 6 months ago, a year ago, I would have said that included gold. I'm not sure that does today, given what we've seen in terms of the memeing of gold.
Right.
But I think there are a lot of other parts of the market that have been ignored, left behind, because they have no sizzle. But those are often the things that have immediate value in a crisis.
Well, and then this is what I was saying before, is like I see this real time with my clients, because I'm the one that gets the phone calls, or one of our advisors gets the phone calls like, I don't understand why we own this dog of an asset. Trust me, it may be a dog of an asset today, but you're gonna be grateful you have it when the time comes. And that's always the hard part. We get so wrapped up in trying to chase the market out. And this is one of my big griefs about the financial industry, which I think has done a terrible job with teaching investors how to invest, which is this whole idea of benchmarking everything. Oh, you've got to be beating the S&P 500. If you're not beating the S&P 500, you need to move your money somewhere else and go do something else with it. The goal's not to, there's no goal out there that you have to beat anything. The goal is to grow your money, at least at the rate of inflation, if not better, to preserve your purchasing power parity over time. But that's 3% right now. Not trying to generate 10, 15, 20% rates of return, which that's okay when it's occurring, but you have to take on a lot of risk to generate those returns. And again, to your point, we get very confident when things are going up. We think we're a lot smarter than we are, because it doesn't matter what we invest in, we make money. But the media, the financial industry has done a very poor job in really teaching investors how to grow money over time and not focus on these things that create more risk in portfolios.
I spend a lot of time looking at ETF creation.
Right.
What are the new products that the ETF industry is generating? And I think that is a great way to look at sentiment, because you can see that they add leverage. It goes from 2x to 3x to 5x. It flows what is most popular. And I think investors need to be really careful The financial industry will serve up whatever is the hot dish of the moment, but investors need to be really picky eaters because I think they are easily seduced by, to your point, what is hot, and they pile into more and more of it at precisely the wrong moment.
Right. Well, but again, this is all over the media, right? It's what's on CNBC right now. It's, it's whatever hot stock's going up or down. They're interviewing some CEO about this company or that company because it's going up. You've got Robinhood. We've got all these online trading platforms that have gamified investing. And so no longer do we invest. We've really created a gambling environment that, I think has long-term negative consequences. And again, I think this contributes a lot to this kind of K-shaped economy as well, is that, for people that have money that can invest and they can withstand volatility, they can make money over time. But I've seen a lot of young individuals, I saw this in particular in 2021. We saw a lot of young individuals get their $1,500 checks from the government. They went and opened up a brokerage account. They went and bought the meme stocks. And they were writing articles about this in the Wall Street Journal, how some kid took $1,500 and turned it into $500,000 trading options and everything else. And then in 2022, they followed up, and that same guy has now lost everything. He's back to work, waiting tables, whatever it is. So all that wealth building capability was stripped out because the whole financial media has been driving these people to become more gamblers than investors. And, and when we talked about responsibility earlier, I think part of the responsibility, if we want to solve part of this K-shaped economy, is starting to get away from and go back to the realistic principles of investing. Stop, and look, it's a money-making machine for Wall Street, so there's no incentive to do this, right? They'll sell you whatever product because that's how they make money, but it's not helping young, a lot of the financial media is not helping young investors become long-term survivors of the market.
No, and I don't think the industry appreciates that as confidence falls, the moral compass changes again.
Right.
And so it is likely to see, significant restriction on who can invest in what ahead. And I'm not necessarily saying that's right or wrong, but I think that we have gone too far in enabling people to truly, to your point, to gamble as opposed to invest.
It's interesting. I had this conversation just the other day and there's been a lot of conversation, and I'm going to get off ETFs here in a second, but it's just kind of an interesting point. For the last really 20 years, 25 years, there's been this drive, lower costs, lower fees on mutual funds and ETFs and these type of things. And hey, I get it. It's good, right? You should have low fees. But there's been a consequence of that, which is piling more and more investors into ETFs. Yeah, they're low fees, and yeah, you're tracking indexes, and people are trading ETFs, and treating them like stocks, and they're buying baskets. But we've had this big pickup in turnover over time, and there's been so many studies that show that the more you trade, the less money you make. And lower fees, zero trading commissions, and all that has certainly given more people access with smaller amounts of money to invest in markets. But I'm not so sure that's been a good thing. I mean, back in the old day, Peter, back when you and I were growing up, you had a broker, he charged a commission for a stock, and the average holding period was 6 years. So you actually allowed money to grow and invest and work over time. I'm not so sure that a lot of these transitions we've done in the last 20, 25 years, yes, it's made markets more accessible. Yes, it's democratized investing for the average investor. And now they want to start bringing private equity and private credit into 401k plans and make these things readily accessible to the average investor. I'm not sure any of that is really a good idea for the average American.
I agree.
I was hoping you could give me more.
No, again, you're preaching to the choir. I worry that the industry is moved from helping investors to now preying on them.
Yeah. And
it has lost sight of what responsibility it has in serving. There was a time when the financial industry objective was to help businesses grow. And I think today it has become a business unto itself. and has lost sight of its purpose in the economy.
Right. Well, we've certainly, Fed policy, government policy certainly has all helped that along, right? So, we've loosened SEC regulations. We've done a lot of things. There used to be a day we had mark-to-market accounting. That's been gone since 2008. So, all those little things have certainly helped in that push. Peter, it's, what have we not talked about today that you think is important that, people listening to our podcast should know?
Yeah, I encourage investors, again, it is wonderful to plan for what you can imagine, but what sustains investors over long periods of time is really being prepared for what they can't. And here, one of the things I would encourage folks to consider is that when markets turn down and you start to see panic is actually a reason to be optimistic. Panic says investors are now feeling intensely powerless and uncertain, and ironically that the worst is behind them. So as they move forward, when they start to feel emotional, when they start to have this temptation to pull things out lock, stock, and barrel, to just step back and say, if the markets are panicking, now is the time to be thinking optimistically about the future, not that the world is coming to an end.
Couldn't agree more. So kind of, you're always writing, you're always working on new stuff. What are you working on? Kind of what should we be expecting from you next?
I'm really looking at how all of these concepts involving certainty and control and the confidence map apply at an individual level. Mm-hmm. One of the most interesting aspects of this post-book experience have been the conversations I've had with folks in terms of what it's meant to them at a personal level. The hedge fund manager who says, now I understand my wife's experience with breast cancer better.
Right.
The parent of a high school senior who says, I have a whole new appreciation for what it looks like, waiting for applications, or even individuals who've experienced traumatic events. So I'm really interested in how this framework impacts people at an individual level.
So what's the best way, you write every day for Financial Insights, and by the way, Financial Insights spelled INSYGHTS. So, but other than your website, financialinsights.com, where else can they find your work and upcoming books? What do you got and whatever you have coming out next?
Sure. So I'm on social media on Twitter at Peter_Atwater. I'm on Blue Sky as well. They can also find me at peteratwater.com, which is where I, keep things up to date. And then I do a blog on LinkedIn.
There you go. And look, like I said, Peter, I've been a big follower of your work for a long time. I retweet a lot of your work when it comes out. So again, greatly appreciated. So the insights are always awesome. And I would certainly love to have you back here. So when you get your next book up and running, or you have your next articles are out, and you want to talk about it, let's definitely get together and keep up to date, particularly because I think next year that, potentially we could have a lot to talk about as that confidence potentially shifts in the markets. We'll see. But definitely love to have you back.
No, I really appreciate it. And the feeling is mutual. You provide great advice to your clients, and it's a rare thing these days. So thank you for what you do.
Well, thank you so much. All right. I'm your host, Lance Roberts. And of course, that wraps up our Real Investment Show for today. Of course, this is our continuing interview series. So make sure and like and subscribe to the channel. The more that you do that for me, the more I can get great guests like Peter Atwater here on the show. So again, your views, your support, very much appreciated. Like and subscribe to the YouTube channel. Follow me on LinkedIn at Lance Roberts, as well as on Substack, same name, at Lance Roberts. It's all there for you. Of course, our website, realinvestmentadvice.com. Have a great day, and we'll see you next time right here on The Real Investment Show.